boo. Welcome to Light Investor, broadcasting from Peoria Heights.
Happy Halloween, everybody.
Happy Halloween.
Halloween 2022. Today's topic, Tricks and Treats from 22 by Dr. Lure.
Yeah, but has it all been tricks or treats this year, Mike?
There's been a lot of trickery, but depends where you're looking at it. But
yeah, so we haven't had a lot of treats, and I'm sorry to say that, and we both have experienced friends and colleagues and clients that say, I want to get out. And we say, stick with the plan. And this is one of the reasons why you might be feeling so much pain. So what do we mean by everything bear? What do we mean by tricks? So in September of 2022, if you for year over year, the entire global stock market has lost 31.9 trillion, and bond markets have been worse. And we've been telling people about bond markets the whole year, haven't we, Mike?
We've talked about both, correct? Yeah, a lot of talk about inflation and rates, though, that's for sure.
Yeah, and stay short, right?
Well, and I want to add this, and we covered this in the pregame talk here. To me, when I see numbers like this, it's, the markets are down and it is a loss, but it's not a loss in my mind unless you actually sold and bailed out.
Yes.
And if you stick with the plan, if you've got a plan, this is a temporary loss. And the other issue with bonds being down so much, the bulk of that, as we're going to see in some of these slides with fixed income, is a lot of long-term bonds, because of rates going up, got hammered. But I mean, nobody should be in long. I mean, at least as an individual investor, unless there's extreme circumstances, you should not be in long-term bonds because of the credit risk.
You don't take the risk.
That, yeah.
Yeah, sure.
Much better to stay short.
But I think people can see here from the slide that, there's been a lot of loss out there. The global
painful year.
The global GDP this year in 2022 is about 98 trillion, and the loss of assets from just equities and bonds has been 92.2, so about 94 trillion. Versus September 2008, the loss in equities was about 16.2 trillion, bonds about 1 trillion, and only about 29%, right? So it's been a worse loss than it was back in the Great Recession.
And even more extreme on the growth side of things, which we're going to look at as well. I mean, the value and small have kind of held up better. But I mean, forget about valuations if you just look at the reversion to the mean occurring, right?
Say that again, right? Reversion to the mean.
We'll cover that in a future topic here.
So what's causing all the pain, Mike? What's been causing this? Who said there will be pain when we try to control inflation? Who said that, right?
Right.
Jay Powell.
Well, that and my wife. My wife is my pain indicator. She's told me about it. We're getting ready to go into a recession and the market down, her IRA's down, and then last night she was telling about the price of lettuce at Costco is almost doubled.
Yeah.
So my wife is my barometer for all.
Your wife's your barometer, and she's feeling the pain of the market.
Yes, from the consumer standpoint.
So we're about up to 8.2% inflation. That's a painful thing. It takes less than 10 years to double, or low. The prices.
Cut your money in half.
Yeah, cut your money in half. And inflation causes all kinds of unintended situations. I thought this was a great one. In the last 18 months, we've had some great gains of nominal wages, 5.5% on the Bureau of Labor Statistics. But if you take a look at the inflation, the real wage growth has been underwater. And that's just one indicator, the lettuce from Costco, wages from your friends. And this has led to serious consumer sentiment. American households are definitely feeling the pain, and emotions get into investing world, and that's not a good thing, right?
Right.
Causes a lot of problems. So what's the Fed done? They've increased our interest rates, right? And that's caused a large slowdown. It's a reason why the stock market is pulled back, because you present discount the future earnings, and that's caused a lot of great compression. And this has been kind of a painful thing. Here's what Jerome Powell says. He says, "It is painful for households and businesses. It's the price we pay for bringing down inflation."
Well, and we were talking about this as well. I mean, if you look at what the market's saying inflation is going to be longer term, even 10 years out, that's the difference between the tip spread and the 10-year bond, and it's less than 3%.
Yeah, it's gone.
So the market's saying, the bond market at least is saying that they think inflation is going to cool off, but the Fed's definitely still trying to put the brakes on for sure.
Yep. I have a feeling that inflation is really we have a lot of aggregate demand destruction right now, and asset prices are going down, homes.
Houses, right.
Yeah, so I really think we're going to see some demand side destruction here, which will bring prices down for sure. And, I think it's interesting, like, will this Federal Reserve tightening actually, this is kind of what I was just mentioning, will it actually have an effect on our economy? And the answer is yes. There's a study from Zip and Zhang in 2020 that says, over 60% of the time when the Fed raises or lowers interest rates, it has an effect on macroeconomics, on GDP, and especially if you don't do incremental changes, like small changes. And these 75 basis points changes, we had 3 75 basis point changes in a row, and we're going to have another 75 basis point change here next week, right? And that means 4 in a row. So a 3% increase in Fed funds rate in just, 6 months? And that's going to create a lagged effect, and that it'll be negative lagged effect in next year. So I'm looking for next, it doesn't mean that we're going to have a bad equity return next year, folks, but we're probably going to have sort of a harder landing next year in 2023.
We could. You never know, though.
You never know.
We
right?
don't know. Right?
We don't know, right? So thoughts,
No,
before
you're
we
doing
jump
a great
in,
job. You're doing doing a great job as the economist here.
Yeah, so we'll get into some investing things, because what I want you to follow up with is we're gonna stick with us to the end, because we're gonna show you what to expect. The last, after, what's happening after a bear market, after all the tricks, the trees coming, right? So, anyways, let's get back to some markets here. We've got interest rates going up, and the 30-year fixed is over 7.2% now. That's housing markets are having some trouble. Housing is very unaffordable. It's like 6.7 times your income. So how do people afford that? And it's been a flawless indicator that whenever you see over 10 months of supply of new homes, that's a recession indicator for the next 6 to 12 months. So probably 2023, we're going to approach that with some more hesitancy. So some market performance, right? Been a tough year?
Well, yeah. The markets are forward-looking, so they already are basically forecasting what you're just talking about.
Yeah. So so the question is, are we going to see a nice recovery here?
Right.
If the markets are forward-looking, we're going to see, and that's some of the things we're going to show you here.
Well, if you back up a little bit when you talk about the markets too, if you just look across the board there, the U.S. market as a whole's down, at the time of this, was down 25%. We're back. We've gained some ground there, but small value dimension of the market was only down 9%.
Yeah.
But then again, worse pain overseas, internationally. I think probably a lot of that caused by the war over there. And then fixed income, obviously, longer term is down a bunch. But if you used to keep your fixed income shorter and investment grade, it's not quite as bad.
It's been so tough. even the balanced portfolio, the 60-40, that has been the worst year.
Right. But even more
ever.
so, I think the benchmark 60-40 they're using has an aggregate bond dimension to it, which has a longer term, which is going to even exacerbate the negatives of that. But that might be deeper than we need to go today. Sorry.
But yes, folks, you can't get away from the pain, the tricks this year.
Right, sure.
So tell us about these Fang stocks, Mike. It's your favorite conversation.
Well, I don't know. It's my favorite one. It's been interesting because it's been so good for so long, and it was outperformed. Fang makes up a good 25% of the S&P 500 return.
That's right.
So it's been skewed a bunch for the last decade, and it's definitely reverting to the mean. Forget about valuation story, anything else. And I think we're going to talk about at the end, just even like this past week when you saw Kramer came out, he was crying. I don't watch Squawk Box, but I picked it up on Twitter. He was crying on, I think it was Thursday or Friday, I forget which day it was, about his recommendation back in June to buy Facebook, and then he was blaming it on the fact that they lied to him, and it wasn't his own fault for just...
Who's they, exactly. Right? The management?
Yeah. The management. He's the manager of the company.
It's not my fault. It's their fault,
I think it's
right?
down 5% again today, so it's down probably 70+% from its high. Yeah. But it just goes back to the whole story of diversify. It's great. If you want to speculate and put 5% of your money and know that you're speculating, individual stocks is a great way to try and get rich. But it's, the old saying goes, how do you end up, we talked about this the last time with David, how do you end up with a small fortune? Start with a large one,
Yes.
So diversify.
That's how it helps you stay wealthy, right?
Correct.
And grow too.
Yeah.
So what kind of returns can investors expect after all this bear markets and the tricks they've been getting, Mike? What are some
Well, I mean, if you look at the
1
data
year
here,
later,
I mean, 1 year returns following 20% drop, and this goes back to 29. On average, it's 12, but there's some pretty good years there. So again, it's the whole thing is staying the course. And I think it goes back to, we talked about this about Keynes has a great quote about bear markets. He said, there's been more money lost in people preparing for a bear market than in the actual bear market. And what he means by that is the people that stayed the course got these returns afterwards and didn't lose money like we talked about in the beginning. It was a temporary loss.
Yep.
But if you start to make actions and move and zig and zag, you take temporary losses and you make them permanent.
Yep. So, on average, you expect a 12% rate of return, after this bear market's over, but it doesn't necessarily mean it. You could have some negative years, you could have some positive years. But, look at, in March of 2020, you got like a 73%, 72.6% return. But then maybe in September of 1931, you're looking at maybe a 44% return. But on average, 12% return, folks, after all the tricks are been laid out. How about also the market's performance during recession? So we don't know the future, Mike. I feel that the hard landing is likely. I don't know if the Federal Reserve has ever had a period of time where they've raised rates to try to stamp off inflation, and it didn't cause a hard landing or a recession.
Well,
so
in my mind, it's like trying to park the Titanic in a parking lot for a car, right?
Yeah, it's like that little
pretty big thing to maneuver around.
Yeah, hard for the rudder. But what can people expect for maybe just equities, U.S. stock market performance during recessions?
Right? I mean, all you can expect is it's going to get better afterwards.
Yeah, okay. Very good. Yeah, and you can see this as a kind of a random walk, but it is still yet positive, possibly.
Quite a bit.
Yeah.
The odds.
Odds.
I'm more of an odds kind of guy. The odds are pretty good that you're going to have a good outcome.
Yeah, so
I just don't know when it's going to start.
It's going to start. So out of 10 years, over a 10-year horizon, how many years are usually up?
To have a 10-year horizon.
Yeah, if in any given 10
I guess, what is it, 75%?
Yeah, 7.5, 8 years. Yeah, sure. And so what's some of the investor
live on the
yeah, Lure gives tests all the time.
Okay.
Hang in there, Mike.
Yeah.
So investor takeaways. So, I hope you guys have stayed with us to the end, but what are some takeaways? What are some things that you want the audience to know?
Well, you got this quote here from Jason Zweig, and actually I'll add a little bit of background. That's actually Jason Zweig is actually an economic journalist that I actually like to follow in the Wall Street Journal, and he has his own production as well. But this was his very first post he ever put out on the Wall Street Journal.
Yeah.
And I think it's a great quote. Investing is much like dieting. It's simple but not easy. As we've seen with all the craziness we've covered today,
Yeah, I mean,
confusing.
Yeah, Paul Samuelson, who's a great Nobel laureate, said, investing is should be boring, like watching paint dry.
Yeah, and I think what people don't realize nowadays is investing it's so much simpler to build a really powerful portfolio today than it was 20 years ago because of you had the low cost index funds, you got low cost ETFs, super broadly diversified building blocks for portfolios, dirt cheap, highly liquid. It's easy,
and you don't have to pay a load.
Easy, but,
you don't
you
have to pay all these load funds and high
but
fees.
The key is you're diversified.
Yeah, and the key is you're diversified, right? Yeah, and that's David Ulmer said, right? He
Right.
said, "Stay diversified. You can get growth, and it keeps
so
you
much
wealthy."
of what's still out there for people is what we like to call the noise. It's the forecast of their concentrated portfolios or their silly products that guarantee to take all the risk away from you. But the bottom line is it's all complex, hard to understand.
Yep.
And the odds aren't behind you with that approach, by the way, as well.
Yep.
I mean, like 90% of active stock pickers that run funds, ETFs, over 20 years, and the data's in the SPIVA report, Standard & Poor's, 90% don't beat their benchmark, their relative index.
Yep.
That's keep putting the odds with you. Just stick with the benchmark.
Yep. You remember Ryan helped us with the triumph of the markets when we saw for the first time ever this year indexing out has more assets under management than active.
Yeah, the flows are huge.
The flows are huge.
Yeah, I think if you go back to episode 12 from ours,
nice.
we showed how to build a
This
portfolio.
guy,
I did. Yeah, I sought that out for this morning's conversation. But
well, very good. Any last thoughts?
None.
Well, happy Halloween, folks. If you like the materials, please like and subscribe. It does help our algorithm from YouTube.
And if you got questions, please throw it out there. We'll be happy to talk about it.
For sure. All right. This is the Enlightened Investor team signing off. Take care.